I want to welcome everyone joining us today and thank you for joining us for the Q3 Market Update. I'm Beau Henderson, founder of RichLife Advisors, and today's conversation is really about one thing. It's helping you cut through all this noise so that you feel confident and informed about the decisions that go around that come up with your retirement. Now, to do that, I brought in Jay Coulter, our expert in the markets, the money management of the portfolios. Did I say that wrong, Jay?
Beau, I really enjoy doing these quarterly updates. It doesn't matter how you position me. So I'm glad
Okay.
we get to go through and talk about the markets again. Uh, how's your past quarter been?
We've had a lot of, I know you're going to be shocked with this. We've had the should I buy SpaceX up the night before. A
Mm-hmm.
lot of that. A little bit just as the news comes and goes, we've been getting some of it seems like the ebb and flow of emotion. Well, we've been seeing a fair amount of that this quarter, but overall the quarter's been good. We built the plans at Rich Life Advisors so that, get this, the plans work whether the market's up or down. And that's one thing I tell people. I can tell you exactly what the market's going to do. It's going to go up or it's going to go down.
Excellent. Excellent. I got to tell you, so SpaceX was a big deal this past quarter to
Mhm.
folks that want to get caught up in that type of investment idea. The challenge I have, Beau, and I want to be clear, SpaceX is in the RBI portfolios
Mhm.
because it's in one of our funds.
Right.
But the idea of getting excited about your investments, getting excited about an IPO, in my experience, never leads to good outcomes. So when you're managing your serious money for retirement, remember, we'll go over this in a little while. One of our rules is we want to make sure we're not emotional with our money. And that's what I saw with SpaceX.
Yeah, yeah, and we talked through that, right? Is that, and correct me if I'm wrong, because I had this question come in, but we will add more of positions, or we'll see that show up more in the S&P after it's shown profitable over a period of time, right? We don't get caught up in the emotion of short term, what we've seen in the past, spike, trough, and then hopefully position for long term growth.
That's exactly right. So the RBI portfolios are an acronym for rules based investing. You do not want to have somebody who deems themselves to be an expert deciding when we're adding SpaceX to the portfolio. So here is where it does get added. So today we have an allocation to QQQM, which is the NASDAQ 100. And SpaceX is recently added to the NASDAQ 100 index. So thus the index fund has exposure to SpaceX. S&P 500 took a different approach when it came to allowing SpaceX into their index. They are making them continue with the rules they've held for companies for a long time, and it will be probably about a year until they have reached the rules that they put in place to be added to the index. But either way, our investors are going to have exposure to SpaceX inside of their RBI portfolios going forward.
Very good. So let's go back. I know we do this every quarter, but I think it's very relevant. Is let's set the stage for, and we just kind of hit a lot of that about we don't want to get caught up in emotion. And if our investments are too exciting, that's probably a red flag that something's wrong. But let's go back to when we say rules-based investing. I think we've talked about this so much, Jay, that sometimes we just rattle it off. But what does that mean? What are the rules behind rules-based investing and the philosophy that goes with it? So let's talk through that one more time because I think refreshing that, I don't think we can do that enough.
That's exactly right, Beau. In fact, we'll do it every time. That's how important these rules are. So here are our 5 rules of investing. Number 1, we want to minimize taxes. Number 2, we want to minimize fees. Number 3, we want to remove emotions from the investing process. Number 4, we want to avoid gurus, those talking heads in the financial news media. And Beau, number 5, we want to stay diversified. And the reason these 5 rules are so important is that if a client entrusted Rich Life Advisors with their money, and over the next 10 years we started breaking these rules, how would things work out? If we didn't stay diversified and in 1999 during the internet bubble went all in on internet stocks, or if we started listening to those gurus on CNBC and in the Wall Street Journal who think they can actually predict the future and managed our clients' money based upon their predictions, or if we got emotional and took all of our money out of the markets in 2020 during COVID or during the great financial crisis, Or quite frankly, Beau, if clients paid too much in fees or too much in taxes, they're not going to have a successful outcome with their finances. That's why the rules are so important.
And when we go through the rules, so the five rules, and like you said, you can't argue with those. Those are fundamental investment philosophy. And I love that we restate them because sometimes seeing them in black and white helps us get around that human thing called emotion that drives irrational decisions that causes problems. So it's really built to protect us. Now, let's talk a little bit about the philosophy. There's some philosophy over the rules too.
Yeah. So it's one thing to have rules, which are important. But then when we build portfolios, you have to have a philosophy before you even get started, or else you'll end up with a messy investment portfolio system. So here's our philosophy. Number one, a globally diversified portfolio of stocks, bonds, and alternative investments is the optimal way to manage risk. Number two, low cost, passive investing blended with high conviction portfolio tilts is the best risk mitigation tool. Number three, exchange traded funds or ETFs, they are the optimal investment vehicle. Number four, rebalancing portfolios provides consistent risk alignment. Buy low, sell high. And lastly, aligning investment strategies with personal financial planning objectives of our clients increases the probability of success. That's where the customization comes in. That's where working with Rich Life planners helps you put together the optimal plan for yourself.
And I want to speak to number five. You just said the customization is. So wait, Jay, you're not telling me that I can't just say you're 66-year-old couple with X amount of assets. Here's exactly what you should do, right? You're not a cookie cutter. I mean, you're not a cookie, so we can't use cookie cutter approaches. We have to know who you are, what are your values, what are your priorities, and then the plan fits your goals, your objectives, and we call your definition of a rich life, the life you want to live. So I'm so glad to see that we always include number five there in the philosophy because I see a lot of scenarios. Unfortunately, I'll see statements and I'll have conversations to where I believe that was left out of the conversation in a lot of cases. So.
Oh, it's the most important thing in this whole process. It has to be customized at the client level. And it's important to remember that clients' goals and objectives change. And that's why working with an advisor can be so impactful in the investment process.
It's not a set it and forget it. Okay, so we have the rules, the philosophy. Now, if you will you walk us through very, very plain terms, right? I think sometimes another thing I've been guilty of is being around this so much I can get real financially, right? But in plain terms, how do you decide what changes in a portfolio and what doesn't? And what's kind of going on behind the scenes, behind what people might see show up on a statement, Jay?
Yeah, anytime you're speaking with somebody that puts together investment portfolios like us at Rich Life Advisors, a real simple question can tell you if they actually know what they're doing. You say, what's your investment process? And if they cannot articulate it in very clean, crisp terms, you're just making things up as they go along. And so ours is very methodical, as you might imagine, in a rules-based investing system. We start with a globally diversified portfolio. All of our clients inside of RBI, they own companies in Australia, Japan, Europe, and NVIDIA here in the United States. Global diversification is key. Then we go through a macro and market analysis that we're going to walk everybody through. These are our big indicators, and they help tell us what type of tilts we need to apply to the portfolio. Do we need more exposure to the US? Do we need more exposure to technology? Do we need exposure to resources like gold? That's where the rules and the indicators help us with that. And then we rebalance.
Keeping us diversified, okay, very good. So as we go through a process, again, rules, process, system, right? I didn't hear anything, Jay, in here about there's this strong gut feeling approach you bring to the table.
Yes, we never lick our finger and stick it in the air and try and figure out which way the wind is blowing because that never leads to good outcomes. And remember, it doesn't align with the five rules. There are no gurus that are going to predict the future, and we don't want to invest our clients' money and time in that.
And this is high level. We're looking, and I love the way you broke out this kind of this model into the four sections here. But let's go into. I know underneath this, you're paying attention to the indicators. the indicators that change and they evolve as we go through to run through the process. And I know you typically are going to start with GDP, and it looks like that's what's queued up. There you go.
That's exactly right. And Beau, the reason I love doing these webinars for RLA clients is I find that an educated investor has a higher chance of being a successful investor because they understand the why behind the rules and what we're doing.
Yeah.
So GDP is a term that gets thrown around a lot, but sometimes it's hard to understand. Essentially, it's the gross domestic product of the country. And what we are looking for here is not quarter to quarter moves in the GDP here in the United States. We want to see the trend. Is it growing or is it not? You can see our most recent reading, the U.S. economy grew at 2.1% annualized, and the 10-year average when you strip out the extreme volatility of the COVID quarter is about 3.3. Historically, we look for growth rates above 2% to tell us, okay, there might be some bumps in the economy, but it is growing. Of note, during the most recent reading, business equipment is up 10%. That is the AI infrastructure build out. We believe that's the primary driver for a lot of that. So we're going to get a new reading here at the end of the month on July 30th. I don't anticipate too much volatility inside of GDP. The U.S. economy is growing.
Okay, so economy is growing. Another thing we're going to hear, and I know it's what we check in on, inflation, right? And you, Jay, please speak to it, but it ticked back up, correct?
It did. So
Okay.
you can see on the chart on this slide that the most recent reading is 4.2% as a measure of CPI, Consumer Price Index. That is above the 10-year average of 3.2. This is a concern, and this is why we pay attention to inflation. The reality is we all felt it, unless you didn't buy gas or didn't buy food or didn't leave your house. Last quarter, inflation ticked up,
Yeah.
primarily driven by energy prices, which was probably a direct result of what happened in the Middle East, driving up the cost. So it looks like this might start to come back down in the next quarter or two, but we have to pay attention to it because it needs to be accounted for inside of the portfolios. Inflation is the silent killer of retirement plans, Beau, and that's why it's so important for us to watch it.
Yeah. So paying attention to make sure, because let's speak to that. Someone on a fixed income in retirement, Jay, let's speak to that. Why is this such a concern and something we're watching so close?
Yeah, so if the cost of living in retirement goes up more than your retirement plan income is going up, by default, over time, your purchasing power is going to really be put at risk. And so we want to make sure that a globally diversified portfolio can help protect and mitigate against some of those risks over time.
We don't want our outflow to outpace our available inflow, right? Cash flow, retirement's a cash flow game in a lot of ways when we're mapping out income planning. So another indicator, we talk about unemployment. So we talked about inflation going up, which but also the unemployment numbers were a little stronger from what I saw.
Yep. So we've seen a little bit of an uptick, but I always want to make sure we put this in perspective.
Okay.
Beau, I think I'm significantly older than you by a year or two. In the 1990s, unemployment rate reached highs of 6, 7, 8%. So unemployment today at 4.3 is in line with its 10-year average and really well below most long-term averages that you look at. In fact, since World War II, we've averaged about 5.8%. So the unemployment reading today is not a concern like it would have been in the past. We do want to continue to watch it. I do have some concerns about the younger generation getting out of college and finding work, but we're also finding some research showing that AI is not having the job crunch that some of the doomsayers in the media were telling us it was going to have. So I do not look at this as much of a risk to investors today, but something that we will monitor every single time we get together.
Okay. So yeah, so you do hear a lot of noise about there's not going to be jobs. So that's not the doomsday sayers that it's not impacting like you might see in some of the media or some of the newsletters or things you see. Okay.
Beau, if I could interject an opinion here.
Yes, please do.
I love the productivity gains that you can get from AI. Like I
Yes.
see it inside of my own business.
Yes.
But it is nothing like the productivity gains that the people who run the AI companies are claiming. And so, what
Got
I
it.
find this to be is just another great tool that makes great employees even better and helps people become better at their job and more efficient. So, I think it's going to be a net positive to the US economy and it's going to help us grow the economy and produce the jobs that we needed. It's not going to replace everybody. At least
No.
that's not how it looks now.
And knowing you're a big implementer with AI, and we believe in it too. And what I love about that and the whole rich life philosophy, Jay, is that I believe you said more efficient, but if I can be more efficient at task, I can be more effective at the experience of spending human time with people, which what I think is missing and we'll see become uh, more of a rarer piece of this business of the one-on-one, the quality time, being present, being the person somebody can call when something goes sideways. So, love, didn't mean to have the sidebar, but I do have a lot of optimism for the use of AI used properly.
Yeah, agreed.
So,
Agreed.
and not to sidetrack from indicators, this next one you talk about a lot, and I like to talk about, but even better, I like to hear you talk about it. But I think before we dive into the data, let's do, it can get a little confusing. I remember some of my early investment classes, finance classes. Let's do a quick debrief of this Fed funds rate, what it is, and why we track it. Because again, to me, it can get a little confusing on what it is we're actually paying attention to there.
Yeah, Bo, that's a great setup because this is really important to understand when somebody says interest rates are doing X, you have to understand what interest rates they're doing and who actually controls it. So we look at two different interest rate indicators. The first that you'll see on the screen here is the Fed funds rate. So we have a new Fed chairman, Kevin Warsh, and when you hear that the Fed is lowering or raising interest rates, this is the only rate that they can raise or they can lower. And so Fed watchers want to try to see what they might be doing by analyzing what his team is thinking and what historical precedent the Fed has gone through during different market cycles to try and guess what's going to happen with interest rates. Remember, as part of RBI, we don't guess we don't guess on anything. And so what we do is we watch. Currently, the Fed funds rate is between 3.5 and 3.75. So where they might lower this rate would be lower it aggressively would be like during periods like COVID or during the great financial crisis. And they would do that to try to spur borrowing in the economy. Where they might raise interest rates is when we get periods of high inflation, like we saw after COVID, when inflation was getting up to 7, 8%, and they needed to raise rates to try and cool the economy off a little bit. Unfortunately, the Fed has become absurdly politicized. So all we can really do as investors is just watch the numbers and try to stay away from the noise.
See what the data tells us. Okay. Now another topic, and again, I think this indicator we pay attention to. I'm queuing up 10-year Treasury yield here, Jay. A little explanation, because again, it can be a little confusing about how this impacts retirement and why. So
Yeah.
let's talk about the 10-year Treasury for just a minute.
So very important. Fed funds rate controlled by the Federal Reserve. There are humans involved. There are politics involved. The 10-year Treasury rate is controlled by the market. And the market determines whether the 10-year Treasury bonds are going up because people are buying them or going down because investors are selling them. It's important to note there is an inverse relationship between the value of a bond and its interest rate. So if investors are selling 10-year Treasury bonds, the rate would be going up because the market is requiring a higher interest rate in order to take the risk of owning that 10-year bond. It has become of paramount importance to watch the 10-year because we're at a place right now in this country where we have almost $40 trillion in debt. At some point, these chickens are going to come home to roost, and we want to make sure that we are protecting our investors should that happen. And we do that by watching the 10-year Treasury rate number. And so today, it's important for two other reasons. The first, mortgage rates, 30-year fixed mortgage rates are generally tied to the 10-year rate. So if this rate goes up, it could negatively impact the housing market, which is starting to potentially look a little bit fragile. So we want to pay attention to that. And then secondly, for the fixed income investors out there, it's really important that we watch where the 10-year is and try as we map out cash flows at the financial planning level to make sure as financial planners we're optimizing their income stream over the next 10 years.
10-year. Okay. So we got that. We got the 10-year Treasury, paying attention to the numbers. Let's talk about the asset classes as indicators, PE ratios.
Yeah. So we added this chart last quarter, Beau, and I thought it was really important because it feels like there is this dogma in the investing world that stocks are only going to go up. You can invest money at ridiculous valuations, and you're always going to have great outcomes. I experienced that in 1999 and 2000 as a young investor and young advisor. We also experienced it during other market cycles. So one thing we pay attention to is the PE ratio of the different parts of the market we invest in. The PE ratio, where PE is an acronym for price to earnings, is essentially a measure of how expensive the market is that you're investing in. So to remind everybody, as we construct the RBI portfolios, we're investing in large company stocks as represented by the popular S&P 500. We're investing in mid-sized companies here in the U.S. as represented by the S&P 400. And then we invest in smaller company stocks as represented by the S&P 600. You can see here on this chart where the valuations have started to get stretched a little bit because small cap and mid cap did not look this good last quarter. They've been on a really great run. That's why we're invested in small caps and mid cap stocks. Yep. And the S&P 500 still looks like it's expensive compared to its 10-year average. And Beau, this is why in the RBI system that we implement, we invest globally. International stocks are significantly cheaper, and we want to buy cheaper. We want to invest cheaper. They're significantly cheaper than the U.S. And so that's why having this globally diversified portfolio allows us to invest in the U.S. plus some of these undervalued companies across the globe.
And I love the human nature. Again, I keep going back to this, Jay. I was having a conversation around, I saw some data around a group of people interviewed, and market was running. I believe this was in the 90s. Amazingly, the same 100 people had a dramatically different risk tolerance, and they were much less risk tolerance after the 2001 correction, meaning the same people, but depending on what happened, depending on emotionally what kind of investor they thought they were. What I'm tying into that is also the rules we're talking about here protect us from not being attracted to the things that might be cheap, which is actually what we want because they don't feel like they're growing as much. Does that make sense?
It does. It forces us to allocate into things that we might not otherwise allocate to.
It helps us fight irrational human behavior, which again, not that we do that only if you're human. So that's the only people that's going to apply to. Okay, so.
Well, Beau, if I could give one other anecdote, because we shared it, I believe, a year ago. We had a slide in here that showed what S&P 500 investors experienced from 2000 to 2010. Mm-hmm. And in general terms, they experienced zero return. Zero. But investors in small companies, mid-sized companies, and international companies far exceeded inflation, which is the goal of, one of the primary goals for investing. Right. So whenever we see somebody bring us a portfolio and it's just the S&P 500 and you look at it and you think, wow, they might have had a great experience the past 10 years, but there is a chance that they're going to ruin their retirement without having the proper diversification. That's why this is so important.
You have time for one more quick story?
Please.
So this reminds me, University of Georgia, I was going to be a psychologist. I had a psychology degree, going to go to graduate school. I was working in a group home, and the reason that was a job, I could go and do my job there, and at night I would study. And I remember one of the first things that got my mind interested in finance was I had a 401k at this company I was working for. And I was like, oh, I'd like to learn about it. And I bought Rich Dad, Poor Dad, Robert Kiyosaki's book, right? And uh, opened my eyes to a lot of stuff. But I do remember this very clearly, Jay, and I have a feeling a lot of people do that. My early exposure or my early ideas was I would look at the investment options in the 401k and guess which ones I picked when it showed the data on them.
The top performers.
The biggest number because I wanted to be
Hmm.
part of that biggest number, which totally violates everything we're talking about. Now, 26 years later, I understand how sophisticated and how the rules protect us. But remember very clearly, I thought I was doing something really smart going through saying, I'm going to pick the top five highest performing ones over the last X amount of time. And it's complete opposite of what we should do. So just you took me down memory lane there for a second.
Yeah. Well, and that's actually a great segue into how we tilt portfolios so we can also provide some risk management inside of client portfolios. So there are three tilts inside of our globally diversified equity portfolio. These three tilts in the portfolio that we put in place are driven by rules. It's not Jay and Beau trying to decide that they're going to predict the markets. The first tilt we look at is the data that compares the U.S. debt at currently $39 trillion to our GDP at currently around $29 trillion. So currently, our debt to GDP ratio is 134%. The 10-year average is 119. And I think that is a skewed number. We should probably be showing a 20% one because this number needs to be below 100. And we have not been this high since World War II. So as a result, one of the rules-based tilts we have in the portfolio is that when the debt to GDP ratio is above 100%, we have an allocation to gold in the portfolio.
Okay.
That will change the very month that somebody gets our debt to GDP ratio below 100%.
Got it. Now, not to distract from the investment conversation, but remember what happened with taxes last time during World War II when the GDP or the debt exceeded GDP.
Remind me.
Well, if we overlaid a chart, they were the highest tax rates we've ever seen. They're up in the 90%. Right. So another warning of what happens when our numbers get unhealthy from a global or national standpoint there.
Yeah. Yep. And the idea that taxes will be lower in the future than today, I think, while we don't predict, would be a little bit short-sighted.
Yeah.
All right. So that's our first rules-based tilt. Our second rules-based tilt is trying to help us determine whether we should have a little bit of an extra bit of exposure to the S&P 500. I had mentioned, Beau, the S&P 500 has dramatically outperformed the international markets over the past 10, 15 years. And so while we want to have a globally diversified portfolio, there are times we might want to have a small tilt in the portfolio to grab a little bit extra S&P 500 because these companies have been dominating the world. But we don't want to pick the companies or pick the timing. So we use a technical analysis tool where we have an extra allocation to the S&P 500 companies if they are trading above their 200-day simple moving average. You can see at the chart on this screen that we're trading almost 8% above the 200-day simple moving average. So we have had that extra allocation to the S&P 500. Where that will change is if it drops below that trend line, it will go into a more defensive position on a graduated basis where it is 50% the S&P 500, 50% cash, and then all the way into cash. This specific tool isn't designed to protect us if there are short-term fluctuations in the market. Where this particular tool has been really effective for investors is when there have been long drawdowns in the market, like the great financial crisis or when the internet bubble collapsed. So that's why we have this tilt in the portfolio.
And and this is done, right? We're not sharing people how you do this, and you have to do this. This is done in the RBI portfolios, and that's what I love. The rules are the rules are automated to an extent, right? Let's talk about next tilt.
The next tilt, third of three, is
Okay.
what we call a 12-month dual momentum tilt.
Okay.
We look at two different ETFs that represent two different investment strategies. The first is the popular NASDAQ 100, is represented by the ETF QQQM. These are the high flyers. And what we know by looking at historical data is there are times where that particular index does really, really well. And there are times that it does really, really poorly for investors. The other index that we are looking at is the S&P 500, but laid out in equal weighting. So NVIDIA and Microsoft have the same weighting as the 499th and 500th stock in the portfolio. The reason that's important is during that lost decade I mentioned earlier of 2000 to 2010, where the S&P 500 was flat, this index was up and protected investors because it wasn't heavily weighted to what today would be NVIDIA, Microsoft, and some of the other big high-flying names that are driving the NASDAQ. So here's how this rule works. At the end of every month, we determine whether the NASDAQ or the S&P 500 equal weight has outperformed over the previous 12 months. And whichever index is doing better, that's where our clients are allocated. When that rule changes, we will make the switch for our clients 100% based on rules.
Question for on this topic. Now, the AI companies, they've been leading the way here. You know, we've seen that. Now, do you see this, Jay, as a trend that can keep going, or do you think this could be a sign of we're moving towards a bubble? These are the kind of questions I'm sharing. The kind of questions I get
Yeah.
from prospects and clients.
I think the bubble question is very valid,
Mhm.
especially if you lived through the internet bubble or the housing challenges that we had in '07 or '08. And the thing about bubbles is they're generally only identifiable through the rearview mirror. Very few people are calling them while they are blowing up. Doesn't mean they're not happening. We have a bubble in debt. U.S. debt, if you look at the $13 trillion we have, we might have a bubble in data centers. We don't know. And that, Beau, is why everything we do is rules-based. So should that bubble start to burst and that trend pick up steam, this particular tilt will take us out of the NASDAQ and put us in the theoretically more conservative, equally weighted portfolio.
So it adjusts for that. It protects us from that. Perfect. Okay. So
Correct.
did we have a overall summary of the tilts? There we go. Perfect. So let's do that. So the one pager, because we kind of broke them down, but just when a client's looking at this video, Jay and Bregan, let's do kind of a summary here.
So here is the way to look at how your portfolios are tilted today. As a reminder, you still have a globally diversified portfolio. You own fertilizer companies in Australia, financial services companies in Europe, pharmaceuticals from Japan, NVIDIA, and Microsoft. But we're also applying these tilts based upon the rules that today provide you exposure to gold. They provide you extra exposure to the S&P 500, and they provide you extra exposure to the NASDAQ 100. Beau, if I was to put a term to these three tilts and what they're telling us, this is all systems a go. This is about as aggressive as the portfolio can get today based upon our rules-based indicators.
Very good, Jay. So thank you again for going through our the quarter, right? What are we doing? What are the rules? I think this time we spend every quarter is just really a good reminder. I said it this way a little earlier. It's all the systems, all the processes, all the things being done behind what comes out on a monthly, quarterly statement, right? And they're being done systematically to help us build portfolios that function, right? Versus, again, the biggest enemy we have is human emotion and irrational behavior. So Jay, thanks for all you do for helping us keep this on track and and having an investment process and system that we can build to get us the outcomes we're looking for to build a retirement that functions the way we ideally want. So thank you for all you do. Any parting thoughts or shots? And really, my last reminder here is for clients, we come in for your annual reviews. We'll go over this information. We can answer questions, or of course, you can send in questions. For anyone checking out our investment process and what we do, I hope this was a good overview, and I'm guessing for many people, this is a lot more thorough overview of what Jay said earlier is what is your investment philosophy? What is your process? I think our industry doesn't could do better at being able to answer that in a way that is thorough and complete, and that people can understand what they're doing and why they're doing it. So again, all that's been possible with Rich Life Advisors because of your influence, Jay. So I thank you for that. Any parting thoughts?
Nope. Absolutely my pleasure. If I had a parting thought, it would be make sure you customize your financial plan to your investments. Don't get excited about your investments. Make sure they tie into what you're actually trying to accomplish with your money.
All right. Thanks, Jay. Thank you, everybody. Let us know if we can help.